What's up, guys? How are y'all doing? Hopefully, you guys are doing great. You guys know I am doing great for sure. Let me just find. Uh, I'll just do the announcement right now, and let me take out the chat here just for a second. About the chat. All right. What's up? What's up, guys? All right. So let me just do a quick announcement on my Discord and on my Twitter, and then we'll start. You guys already know the drill. We do this every single time. So this is a backtesting session where I will go over my framework, the way that I approach things, a little bit of psychology, and then we're gonna end with a little backtesting tournament where you guys can join me and play against me. And there's gonna be also leaderboards and stuff, so it's gonna be really nice. If you guys want to jump in, so we're also gonna give away two 50K growth accounts. Shout out to Tradeify for that. They're the best. Always got us with some giveaways. So let me just do this right here and we can start. Alrighty. And then I'm doing this on Twitter. And I'm going to talk about the last quote that I posted today, 57 minutes ago. And this is something we talked about earlier this session, but on Tradeify TV also on my segment. So I want to talk about it a little bit and see what's your point of view on that. Just talking a little bit about psychology because we talk about psychology a lot in those sessions. It's not just pure backtesting sessions regarding technicals. It's also backtesting sessions regarding the overall structure that you have as a trader and as a prop firm trader, because being a prop firm trader has some difference with being a live funded trader. There's different approach you can have, and you need to find the approach that suits you and that fits your style. Okay, so what's up to everyone who's joining? Hopefully you guys are doing great. So right now I put the little cam thing, so if I deviate from the cam, it's following me, so I can't go anywhere. All right, guys. So hopefully you guys are doing good. I'm gonna go over my framework, a little bit of the best, basically the best trades of last week, using the unfiltered value gap strategy. I'm gonna talk a little bit about that strategy. What do I think about it, and what's the framework behind it, also, so you guys can understand how I frame my trades and how I look at the market. Okay, so this is something that I always talk about, and you need to have a framework. The framework is the most important thing in trading. Understanding the 1 minute chart has nothing to do with where price is most likely going to deliver on the day or in the next 15 minutes, the 30 minutes, the hourly. Okay, what I say, guys, is the most important thing in trading is having a framework. What is a framework? It's having a structure on the higher time frame that will tell you, hey, price has a lot of chances of driving back here, so now you need to scale down to a lower time frame, because since the higher time frame is showing you the direction and showing you where the market is most likely going to go, then the 1 minute chart will have actually substance and will actually mean something. The 1 minute chart, if you just look at the 1 minute chart to find signs of aggression from buyers and sellers and then only take your trades off of that during the day, there's going to be a lot of fake outs. There's a lot of break of structures to the upside who will just be manipulation to then just go back down to create new lows. Okay, this is really important. So the first thing that I'm doing, guys, is I have a framework based on the 15-minute and the hourly chart. Okay, M15 and also the H1. Okay, so for the people who've been there for a while, I know I'm repeating myself, but I want you guys to understand how important it is to have a framework and how important it is to frame your trade off of something higher than the 1 minute chart. Okay, a lot of you guys have been introduced to trading by looking at the 1 minute chart, and you guys are scalpers, and me too. But my biggest mistake as a trader was to backtest the 1 minute chart and only the 1 minute chart and try to find reasoning behind what was happening, when in reality it's a stochastic process and everything is just, you know, all over the place. It's really hard to find edge without looking at a higher time frame, basically. Okay. You have to go to sleep. Well, it's all good, Holder. I appreciate you. You're there in every single streams. So man, appreciate you, my brother. So okay, so 15-minute hourly, this is my framework. So before I have those confirmations here, I am not scaling down to the 1 minute chart. Okay, so what is my framework? Okay, I have two types of ways to basically predict where a candle will actually go. Okay, I have two theories basically. Theory number one is the fact that the market goes from a state of balance to imbalanced. Okay, what is a state of balance? A state of balance is when price is in accumulation phase. Okay, what is an accumulation phase? It means that price is basically at its fair value. Buyers and sellers agree on price. So if buyers and sellers agree on price, it means that price will go nowhere. Okay, then price goes from a state of balance, so accumulation, and then to imbalanced. And right here, it means that those buyers are so aggressive that they like the price here, even if it was at premium, and here and here, and they kept on buying. And they were those aggressive buyers were the one controlling the market and was pushing the price to the upside. So here, what is that telling you? It tells you that, okay, price was in an accumulation phase here. Then it distributed to the upside. And when you see those kind of behavior, basically, there is something that will happen, which is called a fair value gap. Okay, you will create fair value gaps while pushing to the upside. And those gaps, when you display so aggressively to a certain direction, what will most likely happen is that there is going to be a market participant that is going to get squeezed. Why? Because if basically price never goes like this, never just runs to the upside without ever pulling back. Sometimes price, okay, every time basically price creates a high, it needs some fuel to go back down, find new buyers, and then push price to the upside again. Find new buyers here on the pullback, then push again. So high, low, higher, low, higher, high. And the principle behind this strategy is wait for us to displace to the upside, look at the 15 and hourly chart. If we created a gap, then look for signs of weakness at those highs in order to trade back towards the gap. Okay, that's strategy number one, and that's framework number one. And what is the reason behind this framework and this strategy? It is those aggressive buyers will start to be greedy, and there is a lot of aggressive buyers here that push price up that made this area a low volume area. Okay, since buyers were so aggressive, those sellers didn't have a fair exchange here. So here is an area with low volume, and price hates those areas with low volume. It needs to retrace back towards them in order for the market to be healthy. Okay, so that's strategy number one. Strategy number two, what is it? Okay, so that is called basically unfilled fair value gap. By the way, guys, I wanted to make a poll there. Is it Drew and Colin are not here now, but do you guys prefer the dark chart or do you guys prefer the white chart? Actually, I want to know, because right now I kind of like the dark charts actually. But okay, so here is strategy number one, unfilled fair value gaps. You're waiting for price to go in a state of balance to imbalanced, and then when you create those imbalances, so those fair value gaps on the higher time frame, so 15-minute, 1 hour, then you scale down to those lower time frames to find signs of aggression in the opposite direction, to find a counter trend play back towards an inefficiency, because you know this is a fuel level. A fair value gap means that price is inefficient. Price ran so aggressively that right now it needs to find fair value. It needs to find balance. Okay. So then this is the first strategy. Second strategy, I had a lot of people asking me about this strategy earlier this morning, and I talk about it a lot on the my segment on Tradeify, which is every single Monday, Tuesday, Thursday, Friday at 12 p.m. Okay, so lunch hour. And it's called the power of three. Okay, power of three. And what is the power of three? Okay, the power of three is being able, in a sense, to just predict one singular candle. Okay, so what is the power of three? It is look at your higher time frame structure and predict one candle. Okay, this will help out a lot of you guys who are scalping and are still looking for some sort of framework. A lot of you guys understand the 1 minute chart to a really good extent, understand levels and stuff, but don't have, you know, a structure that makes it mechanical for you to know where to put your stop loss and your take profit. Okay, it's all over the place, and if you don't know exactly where to put your take profit, your stop loss, and exactly when to enter, you're gonna confuse what's the difference between a good trade and luck. Okay, that's usually what I say. This is why I don't use too much discretion in my system. It's because it's hard to find the difference between a lucky trade and an actual good winning trade. Okay, because if you're using too much discretion, you're always gonna basically sabotage yourself and make you think that your winning trades are the right ones and are the good ones, and your losing trades are the you basically made a mistake, when in reality no strategy has 100% win rate. And even if you have a really good model, you need to lose sometimes, so it doesn't mean that you did something wrong, basically. All right, this is why I hate discretion in a sense. So model number 2, what is it? Okay, it is basically they go hand by hand. Okay, so basically what you're looking at is you want to predict one singular candle on the chart. So if you want to predict a bullish candle, okay, let's say the overall market is bouncing from a really important area. Okay, you want to be predicting one singular candle on which time frame? I'm not trying to predict one singular 1 minute candle, guys. I'm trying to predict either one 15-minute candle, one 5-minute candle, one 30-minute candle, or one hourly candle. Okay, this is what usually I'm looking at. So let's say here, the higher time frame context is extremely important for me to be able to predict one singular candle. But what's the power of 3 telling me? It's telling me a lot of good things about time. What is time? Okay, it's, in my opinion, the most important concept I ever learned in my trading, especially scalping. The thing that is hard in scalping is not to understand direction. A lot of people have the good direction in the market. You know, a lot of people have the right bias, but what is hard in trading is to enter a trade without your stop loss being hit. It is hard to time the trade with a well-defined stop loss and a well-defined take profit. And when I understood time, this is when I understood how to position myself without being stopped, or when to predict some sort of manipulations. Okay, so here, this is price, okay, which is the y-axis, and here is the time, okay, which is the x. So here it's time, and here is price. A lot of people are only using the y, okay, but I'm using time also. Okay, I'm timing the closures basically, and what is happening in order to predict what has a lot of chances of happening in the next few minutes. All right, if it makes sense. So now, what is the concept of the power of 3? It states that every single candle has an open, high, low, and close, but a bullish candle will create its down wick before creating its up wick. Okay, this is the concept of power of 3. So this is a bullish candle. So this is the open, this is the low, this is the high, and this is the close. Okay, so a bullish candle, if you want to predict a bullish candle, timing wise, okay, right here, timing wise, okay, when you look at a new 15-minute candle opening, if you are predicting that the next candle will be bullish, then you want to see that 15-minute candle open lower to create the down wick of a future bullish candle, and then shift above its opening price, hold it, create new highs, and then close right here. This is an extremely important concept. The timing of a bullish candle, the timing of when you create the down wick of a future bullish candle will tell you a lot about why you should enter on a downtick and not necessarily always market to basically FOMO into trades. Okay, entering into when price is going down and you want to see higher is extremely good when you're scalping, and this is what basically this power of 3 concept showed me how to do. Okay, so let's say overall structure, what am I looking for in order to predict a candle? Okay, let's just do the bearish scenario after, which is right now. So every single candle has an open, high, low, and close. So timing wise, a bearish candle should create its up wick before creating its down wick. Okay, this is what the power of 3 is stating. So here in this case, this is my open, this is my close, this is my low, and this is my high. Okay, you see it's different. This is the opposite. Okay, so right here, timing wise, this should open, create the high first, fill it below the open, hold the market structure shift, go back down, and then close. Okay, what's important about this concept is you could position yourself right here at the up wick, which is the highest risk to reward trade ever, but really it still has a lot of substance. Okay, where I like to position myself is either here or there. Okay, so either in the first distribution after the market structure shift, or the second distribution right here, where price is literally showing me its hand and showing me that there's a lot of chances of us going back down. Okay, so I'm riding the trend, I'm riding where I think price is most likely going to expand. But the power of 3 is all based on the fact that I'm looking at a 15-minute candle or an hourly candle or a 5-minute candle. Okay, I am not trying to predict a 1-minute candle. I'm trying to predict a 15-minute candle or an hourly candle based on the structure that I saw right before. So let's go on the chart and let's try to find those concepts right here and try to find obvious trades and not just random trades, pick and choosing random trades. Let's try to find real reasoning behind why price acted that way and where we could have potentially positioned ourselves as being a long participant or a short participant in the market using those two strategies. This is what I do every single week, every single Sunday, or when I'm doing my backtesting sessions. What I'm doing is that I'm reviewing the past week. I'm not just looking at my winners. I'm looking at my losers. I'm looking at the opportunities that I also missed, because there's a lot of value in those. I could be potentially missing out on a lot of profits just because I don't pay attention to, okay, how deep is it actually pulling back? Can I enter right here, be a little bit more aggressive, put a tighter stop, but it will pay off in the current market conditions that we're at right now? So there's a lot of stuff that I'm actually paying attention when I'm journaling and when I'm backtesting in those sessions. Okay, so let's try to find some really good trades of last week using those two concepts. But before that, is there any questions regarding those two concepts? Because I know it could be confusing, but this is just the timing concept of the power of 3. Everyone understands what is a bullish candle, but if you were trying to predict a bullish candle, there's a lot of signs that will tell you to stay out of a trade, or there's a lot of signs that will tell you, hey, there's a big likelihood of that next candle expanding to the upside, so just try to enter on a downtick. Okay, so I don't understand how to use this power of 3 concept. You never know where exactly you should position yourself to get this bearish move. Yeah, exactly, this is what I'm going to tell you. Okay, all right, he said, I don't know when to position myself. I understand the concept of the power of 3, but I don't know when to use it. Really good question. Then right now you need what we call a framework. Okay, so the framework is this one, and the theory behind how to use this framework is the power of 3. Okay, so I said it goes hand to hand. So let's say here in this case, I'm gonna put you in a certain scenario. Okay, so let's say price is going down aggressively going down. And when price is aggressively going down, like I said in the beginning, and we are forming what we call a fair value gap. Okay, so let's say here in this case, we displace to the downside aggressively. When we displace aggressively, I know that price went from a state of balance to imbalance. What is those imbalances that I'm looking at? I'm looking at a 15-minute fair value gap that is still unfilled. Okay, it's not filled yet. So here in this case, I will look at where is my fair value gap. Did we create a fair value gap? Okay, so this is how I'm going to potentially get in a trade that I will have real reasoning behind why this next candle should print bullish and should print to the upside, and use the power of 3 in my advantage. So let's say here we displace to the downside. We have those two candles. We know as soon as this second candle closes, a fair value gap is a 3-candle pattern. Okay, so what I'm going to be looking at is when this candle will open up. Okay, the third candle that will most likely create the fair value gap if we do not trade back towards the first candle's down wick. This is the candle that I'm looking to trade. Okay, so right here, what am I actually doing? I'm monitoring two levels. I'm monitoring the previous candle's low. So I do not want to see this 15-minute candle be aggressive and close to the downside like this, because if it closes to the downside, even if we let a fair value gap above us, then yes, there's a big signs of aggression from those sellers, but it's not telling us that those sellers are getting squeezed right now. It's telling us that the market is going to the downside and is not yet ready to reverse. Okay, wicks do the damage, body tells the story. It's an extremely important concept, and I use it every single time I enter a trade. Okay, so here in this case, what do you want to see? You want to see wicks do the damage and body tells the story. So here, you want that next candle to open up, go down, okay, and close back without basically closing below the previous candles. So if it closes below the previous candles low, it tells you that the body is too strong. Those sellers are too strong. We're closing below the previous candles low. But if you're rejecting the previous candles low and you have an unfilled fair value gap right above you, this is the moment where you could be able to predict the new candle. You could be able to predict that, okay, the likelihood of us closing bullish on that next candle is a whole lot. Okay, we are respecting the overall framework that I had in the beginning. Overall framework is market goes from a state of balance to imbalanced, balanced to imbalanced, balanced to imbalanced, balanced to imbalanced. And in those moments where we create balance to imbalanced, I said that I want to find signs of aggression from those buyers in order to trade back towards those inefficiencies, which is exactly what's happening right now. But when this candle is failing to close below the previous candle's low and is closing back inside the range, letting that unfilled gap right above us, this is the moment where I'm like, all right, there is a likelihood of us printing bullish on the next candle. So what am I going to do? I'm going to monitor this next candle. Okay, so when this candle closes and it closes bearish, what I'm going to look at is, all right, what is the next candle doing? So here, if it goes down, there's basically two things that can happen. Either it rips up towards the unfilled gap, or it goes down, sweep this low, and then gives us a potential good entry back to the upside. But your thought process is the next candle is most likely going to close bullish. So how can you utilize that power of three concept if you think that the next candle is going to expand like this? Okay, this is what you think basically. You think that this next candle will expand that way. And it could be on the 5-minute, it could be on the 15, it could be on the hourly, it could be on the 4-hour. Okay, but you're using unfilled fair value gaps in order to time them. So your prediction is this. Okay, so what is happening inside a bullish candle? Every single candle has an open, high, low, and close. So if you're predicting that the next candle is going to be bullish, then you want to see price opening going lower to create the downwick of a future bullish candle. Is that risky in some scenarios? Of course it is risky, because you're entering on a downtick and those sellers could be aggressive and then sweep that previous candle's low. Okay, so there's two ways you can enter. Either if you have the right amount of structure here, you enter on a break and retest, predicting that this next candle will push to the upside, fill this gap, and then close bullish, or you're gonna wait for us to go back down, sweep this internal low, and then give you signs of aggression to then push to the upside. Okay, this is there's a lot of ways though to determine what are the chances of us going back down towards this most recent low, or us just opening higher into the gap. Okay, this is basically stuff that you can backtest on your own, and stuff that you can find basically how do you like to manage those kind of trades. Do you like to enter a little bit more aggressively, having a tighter stop, or do you like to have a high win rate and wait for extra confirmations and wait for real signs of aggression? Because the best potential way that you could trade that, let's say in a win rate perspective, would be to wait for price to open, go lower, find resistance, then flip above the open. And as soon as it flips below the open, then you know you could be in a potential scenario where this 15-minute candle already printed its downwick. Okay, so then boom, you shift, it holds, and then it closes back bullish. Okay, this is how basically you can utilize that power of three concept. There is also the concept of liquidity that you can use. if you're sweeping the previous daily low, if you're sweeping the London low, if you're sweeping the Asia low overnight, high or low, then, and you have this kind of pattern happening, wicks do the damage, body tells the story, and unfilled gaps need to get filled because price is inefficient currently, then you can predict the next candle. Is that scenario going to happen every single time, or is that scenario going to be accurate at all times and you can just blindly trade that candlestick pattern? No. But if you can basically reprogram yourself into being patient and wait for the best scenarios, 3 scenarios in a week, 4 scenarios in a week, where it actually shows you every single hand, then it's way easier on your mental and way easier to become profitable in a sense. Okay. Second question, Trader Kane says his strat is combining power of 3 on the daily, 4 hour and 1 hour. Can you explain how these time frames can align in these concepts? Really good question. Really good question. And it's the same exact thing because the market is fractal. Okay. So this, what is happening right here, could be happening on the daily chart. Okay. This, let's say right now I said, okay, do this on the 15 because this is an intraday kind of scalp model that is pretty accurate because there's a lot of 15-minute gaps that get created. And if there's a lot of 15-minute gaps that get created in a day, then it means that you could be selective with your kind of entries and basically be super picky with your trades. Okay, the more opportunities there is, the more you can pick and choose, and the more the less you're going to FOMO into those trades. But let's say this happens on the daily. If this happens on the daily, then time frame alignment is the same thing. So let's say for me, when I look at a 15-minute chart, I look at a 1-minute structure. Okay, but the framework is the same. It's exactly this. If I look at a 1 hour, okay, I look at a 5-minute chart to find my entry, but the framework is what? It's this also. If I look at a 4-hour chart and I want to look at the same exact framework and I have the same exact perspective of the market, okay, this next candle has a big likelihood of printing bullish and expanding to the upside, then I'm going to look at what? The 15. Okay, but overall, it's the same exact framework. This is what I said. It's like a lot of people will tell me, do you think it's good to have multiple strategies? Hell no. The best thing you could do is have one singular strategy, but understand multiple frameworks, how to use them in a way to basically utilize one singular framework, but on different time frames and understand everything about them. So then the 4 hour, 15-minute, and then you have also the daily, and then the 1 hour. Okay, so this is basically time frame alignment. So you're using the same exact framework, the same exact candlestick pattern. For value gaps on the higher time frame, where you're rejecting a higher time frame liquidity pool, you have this candle wicks through the damage, body tells the story. So then you expect that next candle to become to print bullish and expand to the upside. So if you expect that next candle to become bullish and print to the upside, then every single down move should be just a manipulation and the creation of the down wick of a future bullish candle. Does that make sense? Okay, so let's say in terms of in terms of what he does, I don't know exactly how he trades though, but what I know is there's opportunities to scalp in a lot of ways. Let's say he sees this. Basically what he's saying to himself is like, all right, I have this range on the daily, I could take discount. I know the market is most likely going to go down, but I could trade from here to here without risking the fact that I want to predict the whole move. I'm taking a counter trend play back to 50% of the previous range because of what the previous candle showed me. This is basically, with the videos that I saw, it wasn't long, but I think I saw that on a YouTube video when he was showing his strategy, but you can utilize discount and premium in order to find those kind of trades and let them run a little bit more. Your first target doesn't need to be this unfilled fair value gap. Your first target could be, let's say you could put your stop loss to break even at this unfilled and then let price push to the upside, fill 50% of the previous range, and then take out your profits. So let's say what he does, I think, is let's say there's a range and the higher time frame is bearish. Okay, let's say it pushes up, market structure shifts. Okay, and then it pushes down. But then, let's say there's a big liquidity pool right here. He knows that when a big liquidity pool gets taken out, and let's say this candle closes back inside the range, he can see a trade back towards 50% of the previous range without having to catch the whole entirety of the move. Okay, so here, let's say it's the range, he's going to take 50% and he's going to trade back towards 50%, counter trend play, but he can take this trade back here, or he can wait for us to come back towards 50%, show us signs of aggression here, enter, and then trade back down. Okay, so multiple ways you can find this power of three concept, but what you need to understand usually is wicks do the damage, body tells the story. And if you wait actually for signs of aggression, and there's multiple ways you can actually find a power of three. There's not just this kind of way. You could have, let's say, price breaking out. Okay, there's also the breakout power of three. It's not necessarily the reversal. This, I showed you the reversal opportunity, but let's say you have this. All right, let's say the market is like this. We accumulate and then we break out of the range. And then you have a higher time frame target. Let's say you have equal highs above you. Okay, equal highs is a really good potential liquidity pool that you can target. And those equal highs are the range made during the Asia session. Okay, let's say you have an accumulation phase here during Asia session and you have equal highs right above you. And you broke out of that range right here. You could predict that this next 15-minute candle, let's say, or next hourly candle, will go back down, feel this 15-minute gap, push back to the upside to basically tap this liquidity pool and those equal highs. Okay, it doesn't need to be a reversal. You could use the power of three on a continuation, and I would even debate that continuations are really accurate and give you a lot of good opportunities in a day on NQ rather than reversals. Okay, reversals, you need to be a little bit more picky. You need to you can't enter too aggressively because you're most likely going to end up with a smelly finger. This is always what we say. Don't try to catch the bottom. Just try to take a piece of the pie and get out. Okay, so let's say here in this case you broke out of that range. Let me show you, let's say, a candlestick pattern that I would potentially want to take. All right, let's say you range here. Right, let's say there's like two candles right here that were just accumulation candles. Let's say this is an hourly chart. Okay, let's say this is an hourly or 4-hour chart. Okay, let's say there's two accumulation candles and these are the candles that created that accumulation. Okay, and then price, there's a big candle pushing to the upside. Okay, pushing to the upside, pointing towards what? Those equal highs, or there's also an unfilled gap right above you, right there. Okay, what you need is context. Why would price potentially go back to the upside? Is that your model? If that's your model, then utilize the power of three in order to position yourself in a way where you understand where the manipulation leg actually should go. Okay, so if you think that next candle should print back bullish and to the upside, then wait for price to open, go lower, and then take your trade. Okay, so let's say price does this, then new candle opens up, goes like this. Wait for price to manipulate to the downside, shift, entry, take profit, and then you see, like, there's multiple ways you can potentially take a trade using the power of three, and it's not necessarily just a reversal or just an unfilled. You could use time-based liquidity. You could use equal highs, equal lows, breakouts. I would say even, let's say, opening range breakout. You could use a lot of things. Okay, initial balance, a lot of stuff. So this is usually what I'm looking at on the chart, usually where I would get my bias from. And the best thing I could say is don't try to predict a whole daily range using a lower time frame. If you're looking at the daily chart and then scaling down to the 1-minute chart, I'm sorry, but this is noise. The 1-minute chart is going to be noise if you're looking at a daily bias. Okay, but if you're looking at a 15-minute chart, the 1-minute candlestick patterns are going to be great for you to understand where price is most likely going to go, or most likely going to expand in the next few minutes as a scalper. Okay, so basically this is my whole framework. Do you guys have any questions regarding anything? I think I touched on a lot of good concept and really good questions that I had. Okay, so basically what he does is the same exact thing, waiting for the same exact thing, and just scaling up a time frame. Moss is a natural born teacher. Clear, concise, paced explanation. Good stuff. Appreciate you, my brother. But yeah, I think I said that last time, but I think I explained stuff in a good way because English is not my first language, so I try to dumb out everything that I know in the simplest way possible. You know, if I explain in French, maybe you'd get lost because I would add unnecessary words and this and that, but in English, I can't go anywhere. You know, I have to stay. I have to stay on the chart. I don't have too much. I don't have too much jokes to tell. Okay, what time frames is the best to apply the power of three? I would say 15-minute hourly on the, let's say, intraday is really good. Intraday is really good to uh, looking at a 15-minute chart and then scaling down to a 1 is the most accurate thing you can look at, in my opinion. The 1 minute, if you're trying to predict a full-on hourly, is going to bait you out. A 15, if you're looking at a 1 minute chart, then it's going to be accurate. It's going to be accurate, and we can find that in a lot of trades here. Okay, let's say the first trade that I saw today was this one. Okay, so basically what happened, we created what we call a fair value gap. Okay, and those fair value gaps, they seem like they're nothing, and everyone understands them, but not everyone understands how to play them. When I see a gap like this, remember what I said about the framework. Price goes from a state of balance to imbalance, and this is exactly what happened. It was balanced every single candle's upwick and downwick, was touching each other. Okay, right here, no kind of imbalance created. Okay, and right here you see 3 candles pushing to the upside aggressively, forming what? A fair value gap. What is a fair value gap? When the upwick of the first candle doesn't touch the downwick of the third. So here we have a really good piece of information that the market gave us. It told us that those buyers were so aggressive that they didn't give a fair exchange to those sellers. So here it becomes an area with low volume. And if that area has low volume, it means that price wants to retrace back towards this area as soon as possible. So here, basically what happened is that I saw there was a whole lot of chances of that new candle pushing back to the downside and creating a bearish candle. This is what I said in my mind. So when I see this, I'm like, all right, every single candle has an open, high, low, and close. And if I do expect that next candle to be bearish, okay, and expand back to the downside, because of what I'm seeing right now, this candle is failing to close above the previous candle's high, which is telling me wicks do the damage, body tells the story. Right here, we are seeing aggression from those sellers, and the body is closing back inside the previous candle's range, letting that unfilled gap below us. What does that mean? This is respecting my framework. This is when I'll scale down to a 1, 2, 3, 5. Before that, I have no sort of context why price would go down. You know what I mean? If I'm not basing my trade off of a higher time frame candle expanding because of the context, how can I actually position myself in a way without being blind, especially without understanding the timing aspect of that new candle opening? This 15-minute candle is closing right now, 9:59 and 59 seconds. We're sweeping buy-side liquidity into a 15-minute bearish gap. Every single, I would say, the reactions you're getting from certain areas are subjective. It's so hard to be like, to pinpoint an exact area where price could give you edge on the long run just based on the level to give you a reaction. You could, in my opinion, you still could, but you would potentially need order flow for that, or volume too. But in terms of candlesticks, entering right here and being able to predict that kind of move is really hard, okay? Because those levels where you're bouncing off of are pretty subjective. Price could have easily bounced from here. You know what I mean? But what we really care about is how that candle closes inside the range of the previous one, letting that unfilled gap, letting an area with low volume. And when it lets that area with low volume, then I have context. Then I know I could potentially be able to predict the next candle. So I'm like, all right, this next candle is going to print bearish. Good. So now, since I know this next candle has a whole likelihood of printing bearish, and every single candle has an open, high, low, and close, then every single up move should only be the creation of an upwick of a future bearish candle. So what you can do is wait for us to push up, let's say, flip, enter, and then go down. Or basically just enter right here, predicting that price is going to go down if you have the right structure. So here, let's go down on those lower time frames and let's try to find signs of aggression from those sellers. So here, utilizing the same kind of concept, and right here, you see it in real time. The concepts that I'm using for my entries, though, are a little bit different, okay? But they're still the same. Your entries are always going to be the same. They're always going to be based on a certain candlestick pattern that always happens on the chart. There is 3 types of reversals and nothing else. The chart cannot do anything but do that. There's three things that could happen. It's either price creates a high, low, higher high, lower low, and then goes down. Okay, so you would use that breaker, okay, a breaker block, to create a new low back down towards where you thought price was going to go in the first place, which is your framework, okay? The unfilled fair value gap framework, okay, which is your M15 fair value gap, which is an area with low volume. Good. This is one thing that could happen. Another thing that could happen is basically we run up without creating any sorts of highs. Let's say break of structures to the upside. We would just run up to the upside like this. We create a low, high, lower low. And then this would be the order block. That's how we call it. Okay. This is the first reversal pattern. This is the second reversal pattern. And the third reversal pattern is the inversion fair value gap. Price runs up without creating any sorts of highs. Price runs down without creating any sorts of break of structures to the downside. It's just pure displacement in both areas, and then it's going to let a gap, and that gap will get inverse, so then you have an entry back down. I never seen in my 4 years of trading any sort of different reversals than those kind of patterns. Okay, maybe you could argue, okay, head and shoulders, all right, it's the same kind of thing that as the breaker. Okay, a head and shoulders would be like the breaker, but added with an order block. So high, low, higher, high, and then you have some sort of accumulation phase, boom, you go down. But it's the same thing. You still have a breaker. Okay, so price could reverse in any sorts, basically in those kind of ways. What you do not want to take trades off of is this. If price does this, and then you see the candlestick pattern on the 15-minute chart, do you really believe that there is an aggressive seller that is present on the ask that would potentially deliver price back down towards this unfilled gap? You don't have enough context on the lower time frame. So this is why plugging the 1-minute chart, 5-minute chart, 3-minute chart, 2-minute chart with that system or with that overall framework will actually make sense. But if you're only taking trades blindly off of the framework, you're actually not going to see any success. Okay. Men talk English like I'm dumb. Stop the drawing. What? But how do you know that the third candle will not continue higher without retracing to the gap? How do you know the third candle will not continue higher without retracing to the fair value gap? The third candle? It can't. What do you mean? A fair value gap is only created basically when that third candle is closing. This candle can't go back to the gap. The fourth one will go back to the gap. You're predicting the fourth candle, not the third. You're looking at how that third candle is displacing. Is it closing aggressively above that second one? If it is, then it's not good signs of aggression from those sellers. It's not signs that the market is going to reverse. Wicks do the damage, body tells the story. The third candle can never reverse. But let's say the fourth. Okay, you meant the fourth. Okay, this is exactly what you said. Okay, so the fourth, let's say, your question was, how do you know that the fourth candle will not continue higher without retracing? Really good question. Okay, I like what I'm seeing right now. Okay, so I'm gonna say that. So there's 2 things, and this is why risk management is so important. It's because there's 2 potential things that could happen. Okay. Either your stop loss get hit or either your take profit get hit. Okay, but if you wait for the right kind of entry models to show you that and pairing it with the candlestick pattern, then you potentially you don't need to wait for price to open higher. Okay, this is how you would basically see the probabilities of you not necessarily seeing that next candle push to the upside and printing bullish. Okay, but if, let's say, exactly the fourth scenario that could happen is a pure chop, price goes absolutely nowhere and gives you that candlestick pattern on the 15. So if price does this, this is how you know that the likelihood of that next candle pushing to the upside is still there, because there's no signs of aggression from sellers at all times here inside this range. It's just accumulation. It didn't give you the right 1 minute confirmation. It didn't give you that. It didn't tell you that those sellers were actually present inside this candlestick pattern. Okay, so let's say here in this case, what happened actually? It is the scenario number 3. Okay, on the 5-minute chart, you could see also here that we created what we call the breaker block, but we never truly closed below that low. Okay, which I don't really like, but let me just show y'all what I see here on this. The play was on the 5-minute chart. Okay, bro, your chat explains it better. What do you mean? What was the question? What's your question, Trader Dog? Can we take our profit using Devil's Mark? This is a good thing you said. All right, but this is a little bit more advanced. I understand reading it. I don't know what to tell you, bro. But all right. Did this happen on NQ though? I'm not sure. Okay, yeah. So, by the way, one thing that I want to state is I never look at the MNQ chart to make my analysis. I always look at the NQ chart. This is what I backtested my whole life, and this is let's say if there is an inversion for value gap on the NQ chart and not on the MNQ, I am gonna be taking my trade off of the NQ chart. Okay, so let's say here in this case, we have our framework being respected. We went from a state of balance to imbalance. We have an unfilled gap below us, so I would expect that the next candle will print bearish. Good. So now, basically, I will take this trade right now at the close of this candle if we have the right structure. What is the right structure? Either we have a breaker block like I showed, which is the first entry model. If we have an order block, I'm going to answer also. Or if we have a inversion for value gap. So here, I will monitor the 1, 2, 3, and 5-minute chart to find those signs of aggression from those sellers. So here, I will go to the 1. Is the 1 a good time frame to tell me the story? Right here, it's not truly the best candlestick pattern that I can see. Yes, we have high, low, higher high. We pulled down, created some sort of order blocks, but we never truly broke below the last series of down close candles that created basically the sweep here. Okay, so right there, I would not look at the 1-minute chart. I would, if there was no inversion here on the 5-minute chart, I would have let price actually push up to the upside, create the upwake of a future bearish candle, re-break again, then I would enter and predict that price would go down. Okay, so here if I go on the 5, I have my candlestick pattern. I have my reversal model, and it was found on the 5. What happened right here? Same kind of framework. A fair value gap is signs of aggression from a certain market participant. So here it shows me that the buyers are being aggressive, pushing price to the upside, and are not letting a fair exchange to those sellers. So here I can say to myself, all right, if we're truly bullish, we should hold this 5-minute gap in order to create new highs. But if we're bearish though, we will disrespect it. Plus I'm going to pair it with my 15-minute candle that is failing to close above the previous candle's high, plus my 15-minute unfilled fair value gap that is telling me that price needs to retrace back down towards this inefficiency to find fair value inside the unfilled fair value gap. All right, that was a lot of talking, but this is basically all the framework explained in a few seconds. All right, so here 5-minute chart closes back below the below this 5-minute bullish fair value gap, tells me that there's more chances of me seeing the low here, so this unfilled gap, than the high. This is what I'm basing my trade off of. So now, and only now, when my framework got respected, now I can trust the fact that this 5-minute chart will actually give me the story. Before that, I have no fucking clue what the price is actually going to go on the 1-minute chart. Price could do anything that it wants on the 5, the 1. It could break structure to the upside, create breakers, hold them, push up. But if you just look at the 1, 2, 3, 5 without seeing the higher time frame candle pushing to the downside and that whole reasoning behind why it should do this and act that way, how can you trust the 1, 2, 3, 5 minute chart? It's impossible. For me, it's impossible. I know there's multiple frameworks and a lot of stuff that could work in this market, but for me, I can't trust a 5-minute chart without having the confidence that a higher time frame candle is going to expand on that side because of the higher time frame structure. Okay, so here, sell, and look at what price is going to do. Boom, 5-minute, and you hit your target. All right, a lot of people hate the hate the boom. People who says boom when they hit a trade, but this is basically what you want to see as a scalper. You want to be right quick, you want to be wrong quick. Okay, so here, if I have this inversion fair value gap as being the framework behind why I'm taking this trade right now, then if I'm losing the trade, I want to lose it quick. I want this fair value gap to get absolutely ran through, this inversion to get absolutely ran through and stop me out. Okay, but as a scalper, I also want to be right. So here is my covering zone. Here is the zone where I would judge that those aggressive buyers that pushed price up on the 5-minute chart are actually being squeezed. Okay, and I usually always use the term squeeze. Let's say buyers are getting squeezed, sellers are being squeezed, buyers are being exhausted, sellers are being exhausted. We need to retrace back to find fair value. We need to find balance. Because yes, I think there's algorithms, not just one, a lot of algorithms, but the best way to actually simplify stuff is to think about the market as an auction and think about the market as with the market auction theory. Price goes up because of aggressive buyers, price goes down because of aggressive sellers, and this is the best way you can explain it because now you can truly understand what is happening inside this fair value gap. What is a fair value gap for me? It's signs of aggression from those buyers. So basically what's happening, what's the reason behind why I would enter in such a zone is because of a concept called covering. What is covering? It's when a market participant is forced to get out of this position because he's actually in drawdown or he's losing his trade. Okay, so let's say we have an inversion fair value gap. Okay, let's say price runs to the upside, creating that fair value gap. All right. So what I'm saying to myself is, right, there's a lot of aggressive buyers that pushed price to the upside and initiated that up move. Okay, they initiated that up move almost right here on that push up. So the chart is a good representation of those whales fighting, those institutions fighting. So when I see this gap, I'm like, all right, the aggressive buyers are located right here. So they initiated that move right here, and they're located between this candle's up wick and this candle's down wick. This is where I'm basically telling myself that those aggressive buyers, those institutions are located right here. So now, knowing that there's a lot of buying here, if we see price going down, closing below that level, what does that mean? It means that the people who went in buys there, okay, and buys there are currently in drawdown. But those institutions, what they will do is that they have a lot of buying and selling power, so they will manipulate price back up towards their break-even spot, and they're going to click on sell to offload their contract to get out of the position. So if they clicked on buy in the first place and now they're forced to cover, then they're going to click on sell. And this is why there's going to be so much selling pressure getting applied from this candlestick pattern right here. It's because of the fact that there's market participants that are getting squeezed. And this is why I want to enter on those kind of confirmations, and also the order block, the breaker, or, confirmations on the 1-minute chart that actually has substance, because I want to see a squeeze. I want to find a reason why, even with my higher time frame framework, that those sellers right here will have enough fuel to push price back down. Okay, and even when I make you guys understand the fair value gap concept, I use the market auction theory. Okay, and let's say here on the market auction, let's say in terms of volume, an area with a lot of accumulation is an area with a lot of volume, but an area with a fair value gap has low volume. So this is basically what the chart would look like right here, okay, in terms of volume. And this area here, we call those low volume nodes, and those fair value gaps are basically low volume nodes. And when price goes from a state of balance to imbalanced, then we create those low volume nodes, and price wants to retrace back towards them. But can you enter blindly right here just because there's a low volume node. No. But if you can time the fact that a new 15-minute candle will open and the previous candle didn't close above the previous candle's high, and this and that concept on the lower time frame, 5 minute, 1 minute, 2, 3, and looking at those inversions, breakers, order blocks, then it makes actual sense to take a short play back down. Okay? A lot of yapping to make you guys understand one singular move that will only be for 5 minutes. Okay, so let's say here, look at the next 15-minute candle, how it printed. We were able to predict that the next 15-minute candle was going to close bearish. Does that mean that we need to take out all our profits right here? No, you could wait for that whole 15-minute candle to close and then take out your profits because it could be expanding. It doesn't necessarily mean that it will retrace, okay? But there's good cues that will tell you, all right, prices could reverse. Let's say looking at those kind of structures on the 15-minute chart, if your candle is already expanding to the downside and you made your 1 to 2 and you're back inside a 15-minute breaker, you should potentially get out of your trade, okay, or take profit at least. Am I right that in this scenario you're actually fighting the trend? Yes, I am actually fighting the trend, and you're right. You're right. This is a counter trend play. This is a play where you want to capitalize on those buyers being so greedy. We are at a premium where we went from a state of balance to imbalanced. So now those aggressive buyers, so basically those responsive sellers, this is how we call them, those responsive sellers will like the price at a premium. Premium prices, those sellers will start to like those prices, and there's going to be passive sellers that will hold the position of those aggressive buyers. If aggressive buyers are the one pushing price to the upside, are now making basically the market push to the upside, if the passive seller is holding price here, this is where you're going to find a lot of resistance. Okay, so the more you displace to the upside and the more you create those gaps below you, the more chances you have to see a passive seller holding those aggressive buyers and us needing to find fuel in order for that trend to keep going. Does that make sense? Could you explain the idea of if we see fair value gaps in NQ and not MNQ? I'm not gonna lie, I'm only looking at the NQ chart, not MNQ. I don't care about the structure. It's safe because you have statistics that say such gaps have to be filled so price can carry in a healthy way. Exactly. The reason why this, let's say, I like the way that I trade like this is that I can backtest the fact that what is the odds of us going back to fill this internal gap before my stop loss gets hit inside this range. You see what I mean? It's not just random. I'm basing my trade off of multiple time frames to actually find accurate backtest. I'm not just looking at a 1-minute chart. A 1-minute chart can do whatever it wants. There's so much data to go through on the 1-minute chart that it's going to be inaccurate. Okay? Let's say a 15-minute gap. You don't create 15-minute gaps the whole day. You create like 3, 4, maybe. You know? You created a gap, another one here. Okay? But here, it wouldn't necessarily be a scenario that I would take. We created a gap here, a bullish value gap on the 15. You see price is retracing back towards it. Right here, I'm not going to lie, I took a long opportunity right there, predicting that this gap was going to hold because of the higher time frame structure. Got squeezed, but you see, another one here. We're creating a bearish fair value gap. Price is displacing aggressively to the downside. We need to find fair value here. If you find signs of aggression from those buyers, on the next candle, you could find a good trade here. Back towards the gap. Okay, so I'm not gonna lie, guys. Right now, I actually need to get in a call with the team. So it was a really good session. It was a session where I explained a little bit more about my framework, my way of reading price, not necessarily being too glued on the 1-minute chart. I'm trusting the fact that a higher time frame candle will expand in that certain way and will deliver, and then I predict that timing wise we have more chances of, if we push to the upside, we have more chances of creating the upwick of a higher time frame bearish candle than just pushing to the upside and being a bullish breakout. Okay, so I appreciate you guys so much. What we're gonna do for the 250k growth accounts, I'm gonna select 2 people here in this chat because I really don't have time anymore. I'm gonna select 2 people here in this chat. and we're just gonna send you a 50K growth account. Okay, so if you ask good questions, you're maybe you're gonna receive an account. So make sure to have your email in your YouTube description. This is how I'm gonna do it this time. So to push people to be a little bit more proactive on the chat. All right, I love you guys. I appreciate you guys so much. And I see you guys tomorrow at the same exact time, 12 p.m. EST. I'm going to be live trading, taking those scalps. I'm a scalper when I'm on those Tradeify TV lives. So appreciate y'all so much, and I see you guys on the next one. Mwah. Peace out.